prices of the companies remain low.
Yeah, sure. I mean, I think I think that's a fair statement. I think the problem that I think a lot of shipping sectors are facing right now, and it's not just the crude market. I think you can throw the product tankers in there. There's a wall of worry. I mean, if you think about oil prices bottoming at $26 a couple weeks ago, the move up in oil has been pretty dramatic. Now, why is that happening? I think that is a function of a lot of built-in recession risks. As people looked at 2016, there was a lot of concerns about recession and what that means. In previous recessions that we've seen declines in oil demand of anywhere from 2 to 3 to 4 million barrels a day. That would be a problem for the sector. But as recession fears have waned and we've seen a recovery in oil, I think the stabilization in the oil price has the potential to lead investors back into the tanker sector. In terms of the fundamentals, I think generally, and having just listened to the product tanker panel, I think the outlook for crude tankers is pretty attractive. If you're under the assumption that OPEC is going to continue to fight for market share, that's a positive. If you think that U.S. Crude oil production is going to start to roll over, which it already has, that's a positive. So when you think about the demand characteristics, they look good. When you think about supply, it looks manageable. So more happy to debate, but we're bullish on crude tankers. I guess we can move on to the next sector.
Robert, do you have anything to add?
Touching on the points, I don't disagree. I think everyone also worried because of the fact that asset values have continued to be under pressure despite the strong market. I mean, you look at the order book and people are a bit concerned, but the reality is it can be manageable. I mean, people do think 17 will probably be a little worse than 16, but we're not talking a huge depression. It's not the same as dry bulk where there was an oversupply for 6 or 7 years. I mean, 1 year of a little bit, you're seeing extra vessels being delivered isn't going to destroy the market. And demand continues to be strong. So I don't think you're going to see asset values improve significantly. I think we're in a different world. There's a bit of deflationary pressure all around. So asset values may not move that much, but of course the cash flow yields on these vessels is fantastic. So people need to start looking at cash flows a little bit more than improving NAVs. But I think the fact that asset values were falling despite the strong rates spooked investors as well.
Yeah, I personally think the crude tanker market is fine. If someone can tell me what's wrong with $60,000 a day spot VLCC rates, please do. I mean, 1 year, 3-year time charter rates are fine. I mean, companies are making a ton of cash at 45 to 50 grand a day if that's what the outlook is for the next year or two. I think if you look at the tanker stocks, it would tell you a different story. But I also think that we're all overthinking a little bit. I mean, if you guys can remember, about a month ago, pre-OPEC freeze talk, there was discussion or rumor that OPEC or the Saudis and the Russians were going to cut production by 5%. Oil rallied 5% on the day. The crude tanker stocks rallied 8% on rumor that OPEC was cutting. So to me, it just kind of highlights that traders trade stocks on what's working, and what's been working is to trade tanker stocks in line with crude prices. And so whenever you have tanker stocks up 8% because of OPEC's cutting, it just kind of shows you that that the types of investors that you want aren't currently that involved in the name. And so therefore, if you look at the stock action over the last month, 2 months, 3 months, it's not really telling you what's really happening in the tanker market. My personal opinion is the products tanker market is probably the most misunderstood of any shipping market on the street. I mean, what other sector would you have every single asset class seeing their highest level of earnings since 2008 and a shrinking order book? I mean, when you look at the overall products tanker order book, you were at 5.3% fleet growth last year, 4.8% this year, 4.3% next, and that's probably conservative if you consider there's going to be additional slippage over and above what some of those figures suggest. And so when you look at how that setup is, there's no reason why some of these stocks should be trading where they are. When you're looking at 4.8% fleet growth, all you need is about 1 million barrels a day of extra refining capacity being added globally. That will absorb all of that. So whenever they were talking about all the trading arbitrage opportunities, everything else, that's icing on the cake. So the market outlook for the products tanker market is at least as strong as it was last year. And it's just a major disconnect between kind of what the equities are pricing in versus what the outlook is. I mean, I think Ben mentioned, the cash flows of these companies are very, very positive. And so, the market doesn't turn just because. It doesn't turn because it's turned in the past. It doesn't turn because of gravity. It turns whenever you overorder and your supply growth is actually decelerating over the next couple of years.